Welcome back to the channel. So today I want to talk about how to buy real estate during a high interest rate market that we're currently going through right now. So for those of you who don't know, I bought a 20 unit apartment complex 1 year ago in May of 2022, and I bought that for $350,000 using a hard money loan. At the time, the hard money loan interest that I locked in was 9% interest only, which I thought was kind of high. But fast forward 1 year later, now I'm being humbled as to what the interest rates are. So 1 year later, this is what I'm being quoted. I'm reaching out to probably 10 to 20 different lenders, local community banks, regional banks, national banks, brokers. And I'm just having a lot of difficulty doing a cash out refinance on my 20 unit apartment complex. If you want to know more about my 20 unit apartment complex, check out my prior video. But at a high level, I bought it for $350,000. I put in $120,000 of renovation. I'm all in for $470,000, and the ARV, or after repair value, is around $700,000. So when I underwrote it a year ago, I thought the ARV was going to be $800,000, but given that interest rates spiked up so much, it decreased my ARV because I cannot take out as much of a loan to hit that debt service coverage ratio. So just to share a couple quotes, Bank of the West, they quoted me 7.5% interest, uh, 5 years fixed, and 30-year amortized loan. I reached out to a bunch of local community banks in Oklahoma, and it ranged from around 8.5 to 9.5% fixed for 3 years and amortized over 20 years. So out the gate, as you can kind of see, Bank of the West is giving me the best terms. In Oklahoma, they're a medium-sized bank. They're not huge, they're not small, so they're giving me decent terms. But they look at my debt to income ratio as well as my debt service coverage ratio on the property. So they look at both me and the property. Same thing with the local community banks. So the local community banks, they typically like to invest in their community. So I literally just Googled local community bank, the name of the city, Oklahoma, right? So for example, local community banks in Enid, Oklahoma, and I got a list of like 20 of them, and you just start cold calling them or cold emailing them because some of them don't even lend on apartment complexes. And I sent out around maybe 10 emails to 10 local community banks. Maybe two reached out to me. And at that point, you basically have to tell a story. And let me share the story that I've been giving to all the lenders that I've been talking to is, hey, my name is Stephen or Dr. Stephen Nguyen. I'll use my doctor title and leverage that to have more credibility. I'm based in California, and I bought this 20 unit apartment complex about 1 year ago in May of 2022. And what happened when I took over the property, had a lot of turnover. I renovated about 14 of the 20 units on average for around $5,000 to $10,000 each, depending on what needed to be done. If it was a heavier renovation, I did new kitchen, new bathroom, new flooring. That cost around $10,000. If it was a more moderate turn, I didn't need a new kitchen. I typically average around $5,000 per unit. For new floor, new paint, doing touch-ups here and there. And basically, I did a lot of renovation over the past year, and the property is currently at 90% occupied. So basically, when I bought the property, 15 out of 20 were occupied. Within 1 month of ownership, I had about 8 tenants leave due to non-payment, due to bed bugs, due to various reasons. And this is very common to have tenant turnover because you want to get a better tenant base as you're doing renovation. So it actually works out in your favor a little bit, minus the cash flow. But I dropped down to 7 out of 20. At that point, I renovated those 13 to 14 units and then leased it out at a higher rate of 500 to 550 per unit. And then I was doing that over and over. So what's nice about telling the story is that it kind of shows them the big picture of what you've done and how you operate the property over the past year. So what did the loan officer get from my story is, number one, I renovated a lot of the units. They like to hear that, hey, this guy's willing to put in the money to renovate the units and make it nice because the bank's going to lend on this asset. Number two is that despite huge tenant turnover, I was able to lease these units out. Like in just end of April, early May, I literally leased out, I think, 4 units. That brought me from 14 out of 20, which is 70%, to 18 out of 20, which is 90% occupancy. So literally, when I first engaged these lenders out 70%, but every time I leased out a unit, I would give them my updated rent roll and also show them that, hey, like I'm actively leasing out these units right now. So they see the story and they see the proof. And on the rent roll, they can see that, for the bigger renovated units, I'm getting 550. For the units that are a little bit smaller, it's about 500. And they can see it on the rent roll. And then I still have two more units that I'm actively trying to lease out. And who knows, they might be leased out before the loan closes. So it just shows that, number one, I'm a good operator. Number two, I have a good property management company. Number three, I have a general contractor who's going in there fixing up the units. So it's just a great story to sell. And at that point, a lot of the lenders will typically ask, okay, like, what do you think the value is worth? So for me, I'm pretty realistic. I'm honest. I'll say, I think conservatively it's worth around $700,000. And why I picked 700,000 was because at that price point, I could pull all my down payment, all my renovation costs, and probably additional $50,000 on top of that, right? That's roughly around $250,000. So I kind of did my math, my underwriting beforehand. But a year ago, I thought it was gonna be worth 800. So imagine that I could pull out even more money on top of that. But who would have known interest rates would have went up this high? So at that point, they tell you the story and they said, okay, well, if I'm based in California, they said, well, why Enid, Oklahoma? You have to give my story. Like, I have really good property management there. It's more affordable in Oklahoma compared to where I'm at in California. And a lot of times the lenders are typically impressed by how well I bought the property. I bought it at such a cheap price. And at that point, they'll usually say, hey, I'm going to need these initial documents to look at the deal. So what do they ask for? They're going to ask for the past 3 years of tax returns, a personal financial statement, which kind of shows your net worth, a real estate debt schedule. So that's going to have all your properties, uh, the LLC entity that owns your properties, who has a loan, which bank has a loan on it, what are your kind of lending terms, how much debt do you still have on it, what's your monthly payment all in, and how much rent are you collecting. So they're just trying to collect to see how much you cash flow overall, right? So they're looking at your debt to income ratio. Typically they'll give you a template that you can use and you just fill it out. And what's nice is once you fill it out one time, say the personal financial statement, you can give it to all your different lenders. So that's nice. On top of that, they're going to want a T12, so a profit and loss statement since you own the property. Typically, you get that from your property manager. They're going to want a recent rent roll. If you're working a W-2, they may ask for a recent pay stub. And on top of that, they may just ask like some LLC documents. So that's just kind of a high level of what you do. And typically, because I've engaged, 10, 20 different lenders and sending them documents, I have all that ready to go. So usually when they send me an email, I'll usually say, hey, the moment you send me an email, give me an hour. I'll respond back with all the documents that you need. And if you need additional documents, let me know. I have those ready to go. So they usually like that, right? And it shows that you're buttoned up and that you're a more seasoned investor when you can give these documents timely and explain it, right? So at that point, they're going to analyze the deal and send it to underwriting. And then once it's submit, so sometimes the loan officers will say, hey, you know what? We don't like this deal. Don't be discouraged by that. It's very common. Like different banks have different appetites for different types of real estate, right? So like some local community banks said, you know what, at this time, we're not interested in this deal. Don't take it as it's a bad deal, right? At that point, I typically try to ask why to learn a little bit more because I might have that same hurdle down the road later. So it's very common that I usually will ask, well, why? Why did you reject the deal so that I can learn and do better for the next time? Right? Sometimes they just say, you know what, our bank, we're at max capacity on multifamily, and that's it, right? So be it. And then at this point, you move on to your next, lending options. But if they move forward with the underwriting at this point, they're going to do a deep dive. So like Bank of the West, man, it's been a struggle, just trying to get approval. So initially they actually said, you know what, we want to see more cash flow on this property, on this 20-unit apartment complex. And I just said, well, like, what do you mean? And they just said that, yeah, it's only 70% occupied. We kind of see a little more occupied. So I said, okay, well, I'm actively leasing out these units currently. So let me get an update from my property manager. And so I was calling my property manager, every day and basically found out that, oh, wow, we actually went from 70% to 85 to 90. So I just said, hey, like we just leased out 4 units. So that's going to increase my cash flow. It's going to make it easier to hit the debt service coverage ratio. And then it's going to be over that 1.2 threshold, right? So keep in mind when underwriters are underwriting the deal, what they do is they want to see a debt service coverage of at least 1.2 or 1.25. And they'll do a stress test where the interest rate that they tested at is higher than what you're actually going to get. So, for example, if my interest rate is 7.5, they might stress test it at 8.5%. And also, they'll reduce the amortization schedule. So, the loan is amortized over 30 years. They'll stress test it at 25. So, you can ask them, hey, how do you stress test the property? And from there, you can do the math for yourself and see what they're seeing. So, at that point, I said, you know what? Hey, I leased out 4 more units. I should have more cash flow. My rent roll went from 7,100 a month to around 8,600 a month, which is a big jump up. But hey, if like you're still not hitting the debt service coverage ratio, I don't mind lowering my loan amount, right? Like if I lower my loan amount, what does that mean? It just means that I pull out my down payment, I pull out my renovation costs, and I'm leaving, and then I don't pull out an additional $50,000. That's okay, right? Like as long as I get my down payment or my renovation costs, I'm happy. But even if I left in maybe $50,000 in the deal, I mean, the fact that you bought a 20-unit apartment complex, so only $50,000 out of pocket, that's still a crazy deal, right? So don't be discouraged if you leave money in when doing a cash out refinance. Who would have known interest rates would have jumped up this high, right? So, I just said, okay, great. And at this point, the underwriter, they were going so heavy into my tax returns. I've never had a lender go this deep into my tax returns. Even when I bought my 26 unit with Bank of the West, they didn't really ask much about my tax returns. I guess it is on me that, I bought a bunch of value add real estate. I bought a mobile home park, I bought a 26 unit, I bought a 20 unit. I have a bunch of single family homes that are net cash flowing. I'm doing a bunch of renovations into my mobile home park, 20 unit and 26 unit. So my tax returns don't look great. Like, I'll be honest, they don't look that great. I have a W-2 job, but over the past years, I've been laid off. During the time I've been laid off, that's when I've scaled my real estate portfolio. Kind of had a disdain towards pharmacy for a little bit because of getting laid off. But, now that I'm back and working, I'm actually more appreciative of my job, given this current economy and just having the stability. So, like, literally, Bank of the West said, hey, over the past 3 years, your W-2 income has been trending down. Like, why is that? Like, what's the story behind that? So at that point, I said, hey, I was working in Northern California. The average, pharmacy director salary was, 210,000. But now I'm relocated to Southern California, and the average pharmacy director salary is 170. So that's going to be a $40,000 drop off in W-2 income. So that's another reason why I'm trending down. And number two is I got laid off. So I wasn't working for maybe 3 to 4 months, in 2021 and 2022. Got laid off twice. So of course my W-2 income will go down. But at this point, I'm making consistent money. I've been here for the past year. Here's my most recent pay stub to prove it, right? So once you said that story, they said, okay. And another thing too is they didn't like my mobile home park, right? Like, that one is my money suck. I'm putting a bunch of money to fix up the mobile home park. There's a bunch of like operating expense just to keep that mobile home park operational. You have to have a on-site property manager, full-time maintenance guy, someone mowing the lawn, security guard. But, I'm in the process of selling my mobile home park currently. I'll create a whole video on that later when I close, if I close, hopefully, fingers crossed. But, I just said, hey, like if things go well, I should be closing on this mobile home park in, the next week or two. At that point, this will not be applicable anymore. And then my 26 unit, I just said, hey, I just renovated a bunch of units, and now we're leasing up these units at 700 per unit. So I'm basically telling them a story as to like why my tax returns look bad. So I kept on like communication open. I was very honest, very transparent. And despite 2-3 days of back and forth, I finally got a verbal approval that most likely the underwriter is going to approve it. But now I need that written approval to give to my hard money lender so that they can extend my loan. Right? Technically, my hard money loan was due on May 12th. It's currently May 13th. But because I was in constant communication with the loan officer that helped me get the hard money loan, I said, hey, I'm close to an approval. Just give me a little more time. Once I get the approval, I'll give it to you, and we should close within 30 days. Typically limiting step is the appraisal. takes about 1 to 3 weeks. If you can get in 1 week, you close faster. If it's 3 weeks, you might take the whole 30 days. So, just being constant communication, being transparent, and just being constantly persistent. Like anytime I had any update, I just would say, hey, like, we rent out this many units. It just shows you as an operator, and they want to get the deal done, right? Like, 'cause they get commission, to get the deal done. But as backup, I engaged multiple, community banks. So another bank that I was working with was called Stride Bank. They're actually based in the same town as my apartment complex as well. And they quoted me saying, they told me honestly, like, hey, like, we'd be interested in this deal if you hit 90%. At the time I was only 70%, so I just emailed my loan officer, said, hey, I just hit 90%, like, here's my um, updated rent roll. So I just want them as a backup, but their terms weren't as good, right? They want 8.5% interest amortized over 20 years. And I engaged another local community bank, and their terms were actually around 9% amortized over 20-25 years, fixed for about 3 years. But with them, they allowed an 80% loan to value. So if my ARV is 700,000, I can pull 80%. Versus Bank of the West, they value it at 700,000. I only pull out 75%. So that additional 5%, which is probably another additional 30,000. Hey, if you want to pull out more money, great, right? But for me, given my interest rate 7.5%, honestly, that's kind of equivalent to the S&P 500. So at that point, I don't want to pull out as much as I need to. As long as I get my down payment back and renovation costs back, that's good. So I can go buy another apartment complex in about 6 months. Is my goal. I have to give myself a break. So, that's just kind of the struggle right now. So, kind of overall at a high level, this is a really tough market right now with interest rates. You just have to be very persistent. You have to definitely engage, local community banks because they understand the area better. The terms will not be as good, but you just have to be persistent and be in constant communication. Because for me, worst case, if none of these lenders like the deal and want to see it more rented out or more seasoned, then I would extend my hard money loan. My hard money loan would have went from 9% to 11.5%. But to be honest, a lot of these lenders that I was being quoted, they're looking at my DTI plus my DSCR. I was still getting around 8.5 to 9.5%. If it was purely DSCR, I was being quoted 11.5%, which is the same as my hard money loan. So I'm very fortunate that Bank of the West gave me 7.5%. Maybe it might increase, by the time it closes. Hopefully they can lock it in, but it's because they financed my 26 unit. So I have a track record with them. So I think moving forward, by going through all these lenders, I know that in Oklahoma, Bank of the West is probably the best lender to use because they like the market, they know the market, and have a track record with them. So, it was a crazy, hectic past week, talking to 10, 20 different lenders. On top of that, I'm in the process of, closing escrow on my mobile home park that I'm selling. So I'm like juggling two things at the same time. So I've been a bit busy, but I just really wanted to show the struggles and the reality of what the lending market looks like right now. So, if you're going in and you have a good DTI, good DSCR for multifamily, expect around 7.5 to 8%. If you're using a DSCR loan or a local community bank, expect around, or local community banks around 8.5 to 9.5%. And if you're looking at DSCR loans only, you're talking 11.5%. So that's the current market. And obviously, if interest rates go up, your ARV goes down because you have to take a smaller loan in order to get a DSCR above 1.2. So, and then a lot of times too is like I'm doing probably 3 to 5 year fixed loan terms because honestly, if interest rates drop from 7.5 to 5 in, like, let's say 2 years, I'm gonna do another refinance to lower my rate and probably pull additional money on my apartment complex because in 2 years my rents went from 500 to maybe 525 or 515 to maybe 550. And then the ones that are nicer units at 550, they might go from 550 to 575 to 600. So my rents went up. And if interest rates lower, I can lower my interest rate, lower my monthly payment. At that point, my ARV is probably even higher. So I can pull out money again. So real estate's a long-term game. So you want to make sure that you don't have a high prepayment penalty. So I'm doing a loan product where I'm not doing 10-year fixed because the prepayment penalty is too high. It goes 5%, 4%, 3%, 2%, 1%. So you have to own it for 4 years. But honestly, I think in 4 years, interest rates are probably going to lower. Honestly, my personal opinion is I think a healthy interest rate is between maybe 4 to 5%. So I think in about, you know, 2 years, I hope it's going to lower to 5%. At that point, I'm just going to do another cash out refinance, pull out more money, lower my interest rate, and probably still cash flow a little better. So, real estate's a long-term game, but if you buy real estate right, you buy equity day one, have the ability to force appreciation through renovation, raising the rents, building back water utilities, charging for parking, any ways to raise your income, that's how you win in real estate, regardless of what the interest rates were. Like a year ago, I thought interest rates would be around 5 to 6, worst case. Now I'm thinking 7.5% is a great interest rate. But the reality is, if I didn't have a good W-2 job as a pharmacy director, I'd probably be at 8.5 to 9%. So, despite all of that, I'm still able to execute a perfect burr, get all my down payment, all my money back, and just ride it out, right? Lock it in 7.5 for a couple years. I matched the SP 500, so I'm not too disappointed. Just pay it off, pay it down. I'm not going to cash flow as much, so still have to work my day job, unfortunately. But just keep on stacking these deals, right? You keep on stacking these deals. I'm gonna get all my money back from my 20 unit. I'm gonna sell my mobile home park, eventually get all that money back. At that point, I can stack it into a 50 to 100 unit apartment complex in Oklahoma, take it down without partners. Hopefully by then, interest rates kind of simmer down a little bit. Or you can buy deals of creative finance, right? At this point, if you can take over a loan that someone locked in 2 years ago at 4%, or you do creative finance where it's owned free and clear, right? Do seller financing where they become the bank. At that point, you can negotiate the terms that you want, right? Like in my mobile home park deal, I'm seller carrying second some money to help, and they're assuming my seller finance note. So I'm in second position, and I'm being generous, and I'm only charging 6%. But hey, like you could negotiate whatever rate that is, and then still get money coming in. So don't get discouraged. Keep on buying real estate. Surround yourself with people who are buying real estate, and follow this system that's proven. Right? I didn't make this system up. I followed someone else who does the same thing. Buy instant equity, force appreciation, do a cash out refinance. When rates lower, do another cash out refinance because I'm gonna own this for a long time. I renovated 14 out of 20 units. To be honest, after I pull out my money and the additional 50,000, I'm probably gonna use that 50,000 to renovate the remaining 6 units. It's probably not gonna cost me 50,000. It's probably gonna be 5,000 each, so 25,000. At that point, all my units are renovated. I don't have much repair or maintenance besides basic rent ready turnovers after a tenant leaves to make it clean and put lipstick on the pig. So overall, hope you found value from this video. And this is how you buy real estate during high interest rates. Remember, you must buy when others are not buying. That is how you build wealth during a recession. Hope to see you in the next video. Thank you.